Federal Bank stunned the market with a massive 27% rise in its net interest income, and that was helped by a jump in its net interest margins to 3.49% from 3.3 a quarter ago. Its profits are up 54% year on year. Well, it's fired on all cylinders, posted a higher return on assets of 1.3% and is guiding as well for a 1.35% ROA for FY24. Joining me for his 50th results interview with CNBC-TV18 is Shyam Srinivasan, Managing Director and CEO of Federal Bank. Good morning, Shyam. Well, golden jubilee and a golden set of numbers. This is terrific. So first, let me allow you to explain what went so right for Federal Bank, both in growth and margins.
Thank you, Lata. Yes, it has been one heck of a ride. We've had many good quarters and some challenging quarters, but this one thankfully turns out to be a good quarter. I think it's been fairly broad-based, right? We've had all-round sort of improvement in every measure, and it's reflecting the work the bank has done across various periods in time, across different product segments. We've long held the view that if you focus on the credit quality being good without undue risk, then the book ends up working in favor of the bank. Our mix has been, as you know, fairly even-paced between corporate and wholesale, and within corporate and within corporate and retail also is secured, unsecured blend is fairly equally played out. So we haven't overly emphasized in any one business. So I think all that has worked in favor. Certainly this is 5 days of banking summer, as I say it, when the interest rates are where they are, and there is some kind of a timing difference between where the interest rates are passed on the credit and the deposit structure follows. There's some tailwind in favor of the bank. But I think even if you back that out, underlying performance has been very robust across. But most heartening is the ROA expansion has come at a time when the balance sheet has also expanded. So it's not like we've shrunk our way to growth.
I agree.
The book has grown. The book is now, the balance sheet has crossed 2.5 lakh crores, and deposits have crossed 2 lakh crores. The credit book is about 170,000 crores. So it's kind of, I would say, a period when many of our measures are coming together, which gives me the assurance that, the periods ahead should only get better. Yes, there may be some external headwinds, but I think we are in a good place to ride it out.
Okay.
So on balance, we are in a good place right now, and I hope that will continue for quarters ahead.
No, I agree with you that there is a huge tailwind even for the sector. I mean, yesterday we had even Bank of Maharashtra numbers, which were, surprised on all parameters. And that has been the case for several banking numbers. But now let me put the buts and the skepticism for you to defend and see how far things can be, how long things can be good. For instance, margins. We are already seeing banks pushing up their deposit rates, and some of them are raising, even the big ones like HDFC Bank and SBI are raising certificates of deposit, CDs, at higher and higher rates. So are you confident that margins can remain higher even in the current quarter? When do they peak off?
I think in the various calls yesterday post the results, we were quite elaborate in our explanation of what we think will happen over Q4 and the early part of next financial year. Certainly, like I said, the 5 days of banking summer, there's some kind of margin expansion that has happened because of timing. So that will get moderated. But you must believe that there is some kind of franchise value banks like us have. Even through this quarter, if you saw, the retail deposits is what grew. Our deposits sequentially grew 6%. And a large part, and I repeat, a very large part is customer deposits. Of course, it comes at a price. We are not saying that it doesn't come at a price, but we think the retail part of the bank and the franchise is in a good place to grow. That said, yes, margins may moderate to some extent, but over a period of time, the business mix, the credit quality, all this comes into play. So I don't think it will come crashing down. Yes, maybe some...
Not crashing. Even your CASA, your current and savings account have risen by 7% year on year. But as a percentage of total deposits, it's come down from 36.4 to 34.2. So what I'm saying is that increasingly people will want to get more bang for their buck from the banks,
Absolutely.
the depositors, I mean.
Absolutely.
So
Perhaps.
will fourth quarter also see an improvement and then you peak off, or may you peak off this quarter itself?
No, I would think fourth quarter is not going to be much higher, but it will not be much lower either, because the full effect of the deposit pricing takes a good 2-3 quarters. And if there is another rate increase, which could or couldn't be, then that will have its own playthrough, right? So I would think the impact of pricing on deposits will start showing on the margins of banks, but depends on each bank's margin profile, how much will be the fall. Yes, some flattering has happened, but that may get tapered off, but I don't know if it will be very substantial for every bank. In our case, we believe maximum about 10 basis points could be the impact in the coming 2 quarters.
Okay, that's good to hear. Now, let me come to advances up 19.5, almost 20%. Do you see enough demand? In the HDFC conference call, the bankers were saying that they had to refuse some of loans, some 30,000 crore of loans, because, there was too much of pressure of asking for lower yields. Do you think there is so much competition that you can't raise your rates much?
Again, it would vary bank to bank. Our general philosophy is if the credit is good, we should be in that business. Right? I have a 1%, 1.2% share of bank. They may have 10, 12, 13%. So the different banks have different parts of their journey. So I would not follow.
No, the reason why I'm asking you is not margins, but the reason why I'm asking you is quantum of loan growth, therefore.
Yeah,
You think
so
it
that's what
continues at 20 thereabouts?
Yeah, in the high teens is very possible for us, given our sort of phase of growth and the opportunity I see. As long as we don't go crazy and do the wrong things, 18% growth is very possible for us.
Okay.
And that's something that I'm confident we will deliver.
Okay, but you may have to raise capital. I think your capital adequacy is something like 13% or thereabouts. If you grow at this pace, 20%, you may have to raise capital in 24, FY24.
I would think sometime in FY24, yes. Remember, this capital adequacy doesn't include the plowback of FY23 profits, which we do only at the end of March. But that said, our capital adequacy will go to about mid-14. But as a prudent practice, we would consider, but I don't know whether it's in Q1, Q2 of financial 24. But I do see an opportunity to come up with growth capital, and for all the right reasons. We may be in the market sometime in FY24.
There's an insatiable hunger for Indian banking stocks, so perhaps even now is as good a time. But Shyam, now let me come to what the Reserve Bank put on its website in terms of a discussion paper. Now it is not just incurred loss that has to be provided, but expected loss. What may be the impact, not just on your bank, but banks in general?
I would think, we at first glance between the IFRS framework and the more recent discussion paper that came out late last evening, there are some changes. The IFRS, we had a sense of what kind of impact it would be. I thought the capital adequacy impact would be 1.5% for banks. And the provisioning impact would be higher in the near term. But that said, many banks have capitalized well, have increased provision coverage quite substantially. There are some definitional differences in the new circular that has come out. These are draft papers. I would think it will go through a fair amount of change before it goes on stream. But the heartening aspect in that is, I think they're talking of it across a longer period of time, not a knife cut over on one day. So I think they're giving a smooth landing for banks over a period of time. That said, there will be some impact for banks in terms of additional provisioning, only for the fact that the recognition between stage 3, stage 2, stage 1. I think there's some definitional change that is coming up in the discussion paper. But headline, I would say that it's not going to be very disruptive. I do think RBI is taking into view the fact that they don't want to, the banking system is in a good place. They wouldn't want to sort of jerk it away in a hurry. So I would think it would be fairly digestible for most banks. Like I said, in our earlier judgment, the ECL under the IFRS, the impact was about 1% on capital. That may still hold, but this time around it's multi-year. So I think if you raise capital, and I also think we'll start providing more, between now and whenever the timeline comes. So there'll be a little more conservative, prudent provisioning banks will indulge in over the coming quarters.
No, that is exactly the point. Since you will start providing prudentially, that may chip away from the kind of profit expectation and ROA expectation that is built in. You must have calculated the ROA guidance of 1.35 before you saw this paper. Do you think now it may be a bit of an ask because you will want to provide more?
I don't know the impact of it, but I think the big thing is credit provisioning. At least I can say with some confidence, the requirement in the erstwhile IRAC norms is coming down quite meaningfully as the portfolio quality continues to improve. So there may be some space available for us on that count. But I don't want to be too judgmental.
Okay.
We'll work that through.
Okay. Just this one sentence was puzzling. I mean, it looked like it might mean a lot of provision. Expected credit rules include interest lost over the life cycle of the loan. Now, will that mean, therefore, that provisioning will include?
I think that is for stage 3 assets, is my sense.
Okay, so that won't be a great deal.
Yeah, I don't think it will be. I think it will be for stage 3 assets.
Okay, all right. Finally, Shyam, you think corporate loan has arrived. In your case, corporate loans are as good as retail loans in the sense, in terms of the amount. Do you think that corporates now are hungry enough to take it higher?
I think I said this earlier to you guys on an interview. I believe that last year, the one that we are sort of going through, and the couple of years ahead, banks being the principal source of provider of credit for corporates is now real. And those banks that are positioned and are willing to take that exposure will find enough opportunity. We've seen a meaningful demand, maybe because we are a small share player, therefore we are anxious and keen and willing. We are seeing, we meet 4 or 5 times a month for reviewing corporate credit proposals. Right, so there is enough in the pipeline, and I don't see that drying up very soon.
Okay, that's good to hear for the entire banking sector. Shyam Srinivasan, pleasure speaking with you. Here's wishing you many more glorious years in Federal Bank itself, many more golden years. Thank you for joining us.
Thank you.
Well, wrap up on Bazaar on that optimistic note. Chartbusters up next.